promotion type expenses, these are typically related to sales, or there's kind of a correlation between them. They're talking about actual marketing costs, costs of ads. You typically assume that these costs are a percentage of sales, and you have general and administrative costs, and these are wages for salaried employees. Or I should say compensation in general. Rent, office supplies, communication costs, what have you. And these are rarely related to sales. I mean, unless you're paying CEO based on the sales performance, they're not going to be related to sales. In many cases, in a startup, you wouldn't do that. If you hire a CEO or think of yourself, you probably would pay yourself with stock options or restricted stock based on sales amounts and stuff like that. You obviously have depreciation type expenses. Not rarely related to sales, but related to investment in equipment. Obviously, any taxes you have, that are related to sales, to the extent you have any taxable income. We're going to kind of build these income statements in stages. First, we're going to calculate something called gross profit, which is simply sales minus variable and fixed production costs. It is better to work with the so-called gross margin. Technically speaking, gross profit also includes depreciation, but I just want to keep it as a separate item because it's a lot easier to forecast depreciation given investment in fixed assets and given their tax schedules. Gross margin is basically gross profit divided by sales or revenues. So how much of a dollar you get to keep before you worry about any other expenses? That's what gross margin is. So if I'm going to forecast financial statements in the future, it's actually better to forecast sales because that's something that you can use statistical analysis on based on surveys, overall predicted nature of the economy. But once you have sales, gross margin may be kind of a technical number. You know, your Starbucks, how much does it cost you to actually sell that coffee? You don't have to guess. You know, if your comparable company is Starbucks, for example, let's look at S-Bucks. Financials, quarterly, let's look at the last 12 months. For Starbucks, let's see. And I don't want to use Excel just for this calculation. So that also includes depreciation and stuff, but 9,285 divided by 35 or 60. It's about 26%. Maybe I should add back depreciation. If I go to cash flow statement, there's about $1.5 billion in depreciation. There is also some stock-based compensation. Those are not stuff that are related to sales and stuff. I would actually take these and add them back. So that would be 1.7. It's probably a little bit higher. But this basically says it costs Starbucks roughly maybe 65, 70 cents to actually produce $1 worth of coffee sales. Okay? Obviously, some of it is material cost, the input cost. They have to buy those coffee beans from South America, Ethiopia, what have you. They have to pay the baristas. And, the machines cost energy to use, what have you. That's what we mean by gross margin. Gross margin may be, statistically speaking, relatively stable. It depends on the business, but you know exactly what percent of the sales you'll be able to keep. It's going to cost you a certain amount of labor, certain amount of raw material, certain amount of energy to produce it. That may be a kind of non-linear relationship with respect to quantity. Gross margin typically is a lot lower at low quantities compared to higher, because if your production process has what we call increasing returns to scale, it may cost you $5 to produce one car. $50,000 to produce one car if you're producing only 100, but it probably will cost you, $10,000 if you're producing 100,000. There's a returns to scale in some of the operations. Again, this will vary from business to business. But it is something that does not necessarily require an expertise in where the economy is going. Because, if the economy is doing well, your sales are going to be higher, but roughly what percent of the sales you're going to have to spend to produce that amount if the sales are high. So those are more technical and company business dependent numbers. It doesn't necessarily require specific statistical forecasting or forecasting based on surveys and stuff. You don't need to do a survey to figure out what your gross margin need to be. Then we're gonna talk about operating profit. This is typically gross profit minus selling promotion expenses minus, I'm going to call generically, overhead. That's my euphemism for this. Or you can have forecast of operating margin, which is operating profits divided by sales. And if it helps you, there are publicly traded companies for which you have financial data. You can calculate these margins and kind of relate it to their sales, okay?